Welcome back to The Price of Business. I'm your host, Kevin Price, talking to you about you and your business. Going to spend some time with my good friend, Chris Kidd. Love having Chris on the program because that always means we're going to have a great segment. Good to see you, buddy.
Good to be here.
Chris Kidd is a financial coach, does great stuff with lots of different types of people, but loves in particular working with people in the entertainment and sports arena. And we love bringing, crossing the bridge between sports and entertainment and the financial realm. And also, you just got some great celebrities on in general. And I think the guest today, who's really well-versed, spends a lot of time on TV, is going to be an excellent one for us to visit with. Why don't you introduce him today?
Well, my guest today is Doug Kass. He is a very famous hedge fund manager. If somebody's not familiar, just Google Doug Kass or watch CNBC. Or Bloomberg or some of the financial outlets. He writes for Real Money Pro and TheStreet.com, and he also has a new book out that we want to talk about, Doug Kass on the Market. It's a life on the street, and from the little bit that I've read already, it's really awesome, and I'm glad to have him on. Good to have you, Doug.
Hey, Chris, long time, first time.
Yeah.
Hey, listen, you played Sweet Home Alabama to open up the show.
Yeah,
one of the great Leonard Skinner songs of all time.
I agree with that.
And I've used them. I try in my book. I try to intersect pop culture with hopefully some investment wisdom. But I often use the lyrics in that song.
Yeah, absolutely. I love Leonard Skinner music. In fact, I think Simple Man's probably my favorite Leonard Skinner song. And but I love that work, and I'm very impressed with your work as well. Kind of give us an overview, your story a little bit for the audience member that might be unfamiliar.
Sure. I have I run 2 hedge funds and some managed accounts. I've been writing a daily blog on TheStreet.com since 1998. I've written probably 50,000 columns and over 40 million words, as you know. And I've tried to make my blog lively, fun to read, of substance. In doing so, I've rubbed elbows with a lot of famous hedgehoggers and a lot of people that are not so famous, that are infamous, that have delivered some wisdom to me and some basic tenets. My path to in this business is not really the traditional one. It's somewhat unconventional. I studied philosophy undergraduate and in Princeton in graduate school. I was a Nader raider. I wrote a book called Citibank in the mid-'70s with Ralph Nader. I drove harness horses as a hobby. I broke 2 world records, won $1 million race, and was almost killed, ended up in a wheelchair for 2 years in a full body cast after I broke 9 ribs and 11 vertebrae in both legs. I've done some interesting stuff. Speaking of music, by the way, Leonard Skinner's song that you sang, Sweet Home Alabama, was in response to Neil Young's Southern Man.
Right.
So I actually, when I graduated Wharton and got an MBA, I was a concert producer for about a year. I had a traveling group of very eclectic artists, including Ricky Nelson, the Marvelettes, Bobby V, and Bo Diddley. As I said, I majored in philosophy, which is not the way hedge fund managers usually start. And last year, as you know, I was invited by Warren Buffett to appear at the Berkshire Hathaway annual meeting. I guess you could say that my book is kind of my investment odyssey from attending Woodstock the musical back in 1969 to the Woodstock of Capitalism, Berkshire Hathaway's annual meeting.
Yeah.
In Omaha, Nebraska last year.
Well, Doug, I know a lot of people would look at you and say, well, of course this guy can be a good investor and everything. There's so many people that I deal with all the time that they just don't believe that they can, have the time or to actually manage any of their own stuff or understand what's going on in the world of investing. And I know that you started learning at the age of, 16, right?
Yes.
And you learned from your grandmother, actually Koufax, which
yes.
is your
Sandy Koufax's cousin.
Yeah. Okay, yeah, I was going to say, you're somehow related with Sandy Koufax.
Yes. My
Okay.
mother's a Koufax, my grandmother's a Koufax, and he's my first cousin.
So, and I know that you and the guys on the street.com and everybody, you know, with Jim Cramer and you guys do a lot to try to educate the public. So what would you say to somebody who just, you know, they have that excuse right off the bat, just, oh, well, I just don't know enough and I can't learn this. What would you say to just the layman?
Sure. I would say that most investors are best served by using passive index funds because it takes a lot of time to research companies. I am very research-oriented. It's time-consumptive, as you know, and my day starts at 4:30, and most people don't have 14 hours a day to study the market. I think that you have to be a skeptic. I think when your broker tells you that the U.S. is an oasis of prosperity and that we're insulated from the goings-on around the world, such as the recession in Japan, Brazil, Italy, and the chaos in Russia, I think you have to consider John Donne's quote, "No man is an island entirely unto itself." And when your broker tells you to ignore global macroeconomic events, I think you should consider the Great Recession of 2007 and 2009 and its causes. When your broker tells you to rejoice at the rearview mirror of the last quarter's earnings of your investment because there's more to come, please consider that this is a lagging indicator, not a leading one. And also consider that the bottom line has been importantly influenced by financial engineering. When your broker tells you to exult in the heightened M&A activity, mergers and acquisitions activity, consider whether you would own any of those company stocks. Above all, you have to be objective, independent of you. You have to avoid being a perma bull, a perma bear. Permas get attention but aren't money makers. And always, this is really important, assess the reward to risk scenario. What is the upside? What is the downside of every investment? And consider your risk profile and time frames. So invest with your head, not over it.
Yeah, you're really great at that. I mean, you. One thing I like about reading your stuff and listening to you is you have some common sense with all the noise going on, and that's not always taken in a nice way. I know you got a lot of haters that respond to some of your stuff, but you've seen a lot of things that people just aren't paying attention to. I remember you spoke of 2007. I remember back in 2007 you talking about some of the mess that was going on way before anything even started coming up.
Oh, I spent 2 years on the Kudlow report with Larry and debating the perma bulls and trying to explain what was in front of my eyes, which they neglected to see. Some of the malinvestment that we saw back then is starting to manifest itself today, which concerns me as well.
Yeah, let me ask you real quick, what is your website or the best website for people to come and learn more information about what you do?
Well, the free website is thestreet.com, where Jimmy and Kramer and I report. And there's a premium website called Real Money Pro, in which I write literally thousands of words a day in my daily blog.
Very good. Chris?
Talk a little bit about short selling, because I know most people, regular investors out there, they either don't know about it, although more people are learning about it now, but and as well as options and stuff, they're just not really getting educated and they're going doing crazy things. But talk a little bit about short selling and how that works.
Sure. Well, there's a chapter in my book about how to sell short, and a lot of my basic tenets. The most obvious thing, guys, is that the reward versus risk is asymmetric in a short sale. Mm-hmm. You can only make 100% on your money if you find a bankruptcy or a fraud, but you can lose an infinite amount of your money if you're wrong on the upside. Short squeezes are notorious. To prevent that, one of my basic tenets is to stay away. It's a non-starter. Stay away from high short interest ratio stocks. By that I mean short interest in a particular stock divided by average daily volume or divided by the float, which is the outstanding shares less the amount that's owned by insiders. That keeps you from being squeezed. The other thing is that the more I discuss short selling over the last 20 years or so, the more I realize that it's not for most people for that reason, because you really, Chris, have to employ the sort of discipline in taking a lot of short-term small losses in order to stay alive. And believe me, I have the investment scars on my back to show for it.
Yeah, absolutely. What would you say is fundamentally the biggest mistake the amateur investor, if you will, makes?
Well, the most important credo is a simple one. It's easy to write about. It's hard to implement, especially for the smaller investor who gets involved with emotion over logic. And that is, it's important to stop your losses and let your profits run.
Okay, and that makes simple. And it sounds so simple, but
simple, but it's hard to execute.
Yeah, you get your heart involved, and next thing you know, it doesn't quite look right. We got about a minute left. Why don't you wrap it up for us, Chris Kidd?
Well, Doug, I want to ask you real quick. The closed-end municipal bond funds were your favorite for this year. What's your favorite coming up for next year? And what is that?
You're going to have to wait till my surprise list comes out in 2 weeks, Christopher.
I thought maybe we could get a little sneak peek.
I still like the group. Just to do real quickly, I had a variant view that rates would decline in 2014 when every single talking head economist and strategist was looking for higher rates. Now it's odd that everyone's looking for lower rates, and I'm starting to look for higher rates, somewhat so. But I was attracted to the group because rates are going lower. The discounts to net asset value for these funds was large at close to 10%, and it's still large at 5 or 6%. So I still like the group very much.
Well, I know we're about out of time, but I once heard a man say that he paid $200 for a book, and a guy that he was with said, "I can't believe you paid $200 for a book." And his response was, "Well, I didn't pay $200 for a book. I bought a man's life." And what this guy learned over all these years of experience, I can learn in a few hours. So that's what I would say to
really
anybody.
Nice. As Wayne and Garth said in Wayne's World, I'm not worthy.
Well, anybody, they need to go out and get your book. This has got some phenomenal information in it, and a ton of it. So what's the best way to get that?
Go to Amazon.com, Doug Kass on the Market, A Life on the Street. For some time, it's been number 2 in the business category in Amazon, and if you like it, write a nice review.
There you go. Check it out. I think it's must reading, and I think definitely get the advice of those who've gone before us. Thanks so much, Doug.
Thank you. It's a pleasure, and have me on anytime.
You bet. Doug Kass. Check him out there at Amazon. Also, Chris Kidd. Check out his website, Chris Kidd. That's 2Ds.com. I'm Kevin Price. We're going to have more for you right after this on The Price of Business.